morning and welcome to Morning Markets with True Potential. Checking up on news and developments over the past 24 hours. We saw a good market mood yesterday. We saw equity markets and bond markets both delivering solid gains. In fact, UK 10-year gilts delivered their best return since October after Bank of England raised rates by 0.5%. We saw US markets also hitting their 5-month high after Federal Reserve Chairman delivering a more dovish message than previously expected on Wednesday. Mood was also buoyant after Facebook parent Meta delivered somewhat downbeat earnings and sales, but they committed on quite a cost-efficient and cost-cutting plan for investors, and the shares were up as much as 30% on the announcement. The CEO Mark Zuckerberg also hinted that 2023 will be a year of efficiency for the company. The company also announced a share buyback of almost 40 billion over the coming year, so that also boosted overall share prices. Elsewhere, if we saw yesterday, Apple reporting earnings and sales which were downbeat and missed estimates. In fact, sales were down around 5% from last year. What was the reason behind that? Again, the weaker demand from consumers as inflation continues to pinch their wallets, but also somewhat production disruption in China after the COVID restrictions were imposed in Q4 last year. Also, there was stronger dollar was also a headwind for the company's revenue, but overall the company reiterated that the current quarter earnings and sales will be much better than the Q4. Given the COVID restrictions have been eased in China, so the production hangover will be move on in Q1. Looking at Amazon, though delivered beat on sales, earnings and guidance were a little bit lighter than what markets were expecting. Focus on Google, the Alphabet, Google's parent, also delivered lackluster earnings and sales. Again, getting hit from their advertising business and some competition from OpenAI, Microsoft's search platform, which has been launched recently. Focusing on outside tech, Ford delivered solid earnings. Both on the earnings and sales were beat expectations, but also reiterated a full year 2023 earnings picture and boosted the overall guidance for full year 2023. Coming off to the big news though from yesterday was Bank of England and ECB, European Central Bank, raising rates by as much as 0.5% yesterday, but delivering very different messages overall. If you focus on UK, Bank of England acknowledged that UK will enter some recession this year at some point, but both the severity and the length of recession will be much less than what Bank of England was expecting previously. Why is that? Both the inflation is rising much slower than bank previously expected, but also a slowdown in energy prices is boosting overall demand as well. What it means for normal folks on the street, it means that bankers do not expect as many job cuts from businesses as they were previously feared. So job security will be one big factor which will boost reduce the severity of this recession. Though, having said that, Governor Bailey was at pains to highlight the inflation outlook is still uncertain, and any rate rise from here on will be dependent on how the inflation trajectory move from here. Though I think they also hinted that interest rates in the UK are probably closer to peak or very close to peak, and that was a tone which gilts market took and overall risk asset market took, and we saw a good rally in UK gilts market across the board. If you focus on European Central Bank, though it delivered a hawkish 0.5% rate hike, but also pre-committed 0.5% rise in March as well, and also hinted that they may have to see a rate raise further. This is despite them acknowledging that inflation in the Eurozone is clearly backing off, and that will continue to help household. Energy prices have been weakening quite markedly, so that it's all been acknowledged, but still delivering a bit of hawkish message. If you focus on how markets reacted, it was surprising the markets did react much more positively. We saw a good rally in European bonds across the board, probably hinting that ECB may not be able to go as high as they are telecasting, or even if they go, the slowdown in the economy will force them to cut rates at some point. That's on yesterday. What's in for today? We have non-farm payroll data, the job market data in coming out of US later today, which will be one of the key factors for investors to look for ending the strong week overall. So as always, we'll keep posted on how that comes. But thank you very much for watching Morning Markets for today.
If you're interested in taking your investing to the next level, or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.